Picture this. You finally do the responsible thing and start putting money away every month. $100 here, $200 there. It feels great. You are officially disciplined and financially mature. But then you open your banking app and realize something strange. You have $10,000 sitting in that savings account, earning something like 0.5% in interest. That means after an entire year of waiting, you've made $50. Saving money is a good habit, but keeping it parked in a bank account rarely builds real wealth. While we often focus on the divide between savers and spenders, the most significant wealth disparity is driven by the gap between those who save and those who invest. To fix this, we have to look at what your money is actually doing. Savings and investments have two entirely different jobs. Savings exist to protect your money. Investments exist to grow it. Let's look at this chart to see the math in action. If you leave $10,000 in a savings account with a 1% interest rate, you'll make $100 after 1 year. But historically, broad stock market indexes average around 10% per year over long periods. That same $10,000 invested would earn you $1,000 in the same time frame. That difference might seem small at first, but watch what happens when we expand this timeline to 20 years. Because of compound growth, that savings account only creeps up slightly to $12,200. The invested money curves exponentially to $67,000. It's the exact same starting amount, but a completely different outcome. Despite this clear mathematical advantage, the majority of people never make the jump from saving to investing. This hesitation usually has nothing to do with the arithmetic. It's a byproduct of how our brains process risk. When you play it safe and keep everything in cash, you are guaranteeing one thing: the total loss of exponential financial growth over your lifetime. Saving feels safe because you can log in and see a static number. It doesn't randomly drop 5% on a Tuesday afternoon. Investments, on the other hand, move. They go up, they go down, and that emotional volatility feels dangerous. When beginners look at the messy, volatile reality of the markets, they get scared. They see prices dropping, they feel sudden panic, and they immediately assume their hard-earned money is going to vanish. That fear of losing what you've saved is completely valid. To get past it, you shouldn't just dump all your cash into the market at once. You need to handle the transition in distinct, isolated stages. Mastering wealth requires structurally organizing your money. If you set up the right system, emotional volatility simply cannot dictate your financial decisions. The most reliable wealth-building strategy is actually pretty boring. It's just consistent investing. Imagine you put $300 every month into the stock market for 25 years, assuming an average 8% return.
This area graph breaks down your $285,000 balance. Over 25 years, you only contributed $90,000 out of pocket. The remaining $195,000 was generated entirely by compound interest. To get those results, you have to keep making those deposits, even when the news headlines get dramatic and the markets look grim. That discipline is exactly what separates a successful investor from a gambler. You can't time the market perfectly, but time and unwavering consistency will eventually force the math of compounding to work in your favor. So here is the 5-step plan to safely transition your money. Step 1, before you invest a single dollar, build an emergency fund with 3 to 6 months of living expenses in cash. This ensures that if a car breaks down or you lose a job, you never have to panic sell your investments to survive. Step 2 is a mental trick. Separate your finances into a rigid safety bucket and a flexible growth bucket. The safety money stays put, while the growth money is allowed to fluctuate. Knowing your safety net is intact dramatically reduces your anxiety. Step 3 is to start small. You don't need thousands of dollars to begin. Move $50 or $100 into a brokerage account. You aren't chasing massive profits here. You are just building the physical habit of investing. Step 4. Avoid complicated strategies like day trading or crypto speculation. Instead, look at simple index funds. These funds track hundreds of companies at once, giving you broad diversification and much lower risk. It's a remarkably simple approach, and it works. In fact, legendary investor Warren Buffett has repeatedly stated that low-cost index funds make the most sense for the vast majority of people. By stacking these first 4 steps together, you build a financially unshakable base. You can finally step into the stock market without the paralyzing fear of losing it all. Which brings us to step 5. You have to accept that market crashes are normal historical events. When they happen, you just maintain your discipline. Look at this line graph of a market downturn. Instead of panicking, notice what happens when the line drops. Your consistent, static monthly deposit suddenly buys a much larger volume of shares at a lower price. You are essentially buying at a discount. Amateurs react to these dips with short-term panic. Experienced investors stay perfectly calm because they are thinking in decades, not days. Think of saving money like storing seeds in a glass jar. You are protecting them, but nothing is ever going to grow. Investing your money is like planting them in soil. It looks messy at first, but over time, they multiply. Saving money will give you stability, but it won't make you wealthy. Combining that stable foundation with the aggressive growth of investing is how you achieve true financial freedom.